Hi everyone, with a weekly update for the week ended 5th November. In the last 5 days, the equities had behaved differently in different parts of the world. China was clearly strong. India, as usual, relatively strong. US was out and out weak. China was strong because of the rumor of removal of COVID restrictions, which basically means reopening of the economy. And US was weak after the FOMC meeting, which was very hawkish, and the strong employment numbers. When we look at the top 11 countries of the world, we find that India, of course, is the strongest market. The China has been down more than 40%. So therefore, some kind of mean reversal was probably in order. And with the recent times, India has relatively underperformed, so its weight might come down. Another analysis shows that over the past 30 years, China's return to equity investors has been zero. On a comparative basis, the return for Indian investors has been 2000%. So you may love or hate Indian equities, but you can't ignore Indian equities. As a result of India's outperformance, India's weight in the emerging market index has doubled in the last 2 years, obviously at the expense of Chinese weightage. So as I said, you can't ignore Indian equities, and we have an interesting analysis from JP Morgan, and they have pointed out 6 themes which work for investors in 2022, and these are commodities, defense, nuclear power, renewable energy, cyber security, and the last one is India. So India has become a thematic investing theme kind of thing. And why is because India's fundamentals are strong. You look at the recent release of PMI data, the world is struggling to be there at 50 or higher. India is comfortably placed. The composite index is at 55 plus. Then, coming to GST collections, again we have had a 1,50,000 crores plus kind of GST collections during the month of October. And this is the second time we have touched that level. One thing which has held up very well for India is the role played by domestic investors. And in 6 out of last 8 years, the inflows from domestic investors has outpaced that from foreign portfolio investors. Of course, Indian equities is expensive, no doubt. And again, the gap between earnings yield and 10-year yield has crossed 2%, and if you invest, at the current times, there are chances that you won't get an absolute positive return in foreseeable future. Financials have the highest weightage in Indian indices, and when we look at the fundamentals of Indian banks, we find for majority of the banks, the net non-performing asset today is below 1%, and which has happened after many years. So in addition to JP Morgan, Morgan Stanley is also positive on India, and they are pointing to India's strengths in offshoring, manufacturing, energy transition, and advanced digital infrastructure. And they think that India will be the country for the next decade. We are almost done with the September quarterly results, and when we look at market internals, of course there are a lot of headwinds, and headwinds mostly pertain to the valuation part. But there are a few tailwinds going for India. One is that the urban demand has been strong. Second, the domestic investors have kept faith in the markets. Third is the premiumization is still at play. And last is that Indian corporate have reported better than expected earnings. The whole world is talking about recession. So the R word, as they say. And interestingly, this has been the most widely anticipated recession since 1970s. Come to think of it, when pandemic hit, so nobody was expecting a recession. It happened suddenly. Same thing happened in 2008-9 great financial crisis. But when you anticipate, in this manner, or when the event is so well anticipated, the impact of it could be less severe. However, today the market is pricing in about a small negative earnings growth given the expected recession, whereas the analysts still are pointing out to a positive EPS growth. In case the recession is severe, then we will expect this the earnings to be cut significantly, and that would hurt equities. Coming to REITs and InvITs, they don't do well when risky assets are doing well, and so last week was no exception. Now, talking about crude oil went up by nearly 3% last week, and that's because of, again, the China factor. If China is reopening, obviously the demand for petroleum products go higher. Gold went up by 2%, and much to the cheer of the investors in gold, and that's because the dollar got a lot weaker last week. Now, when we have to look at the rupee depreciation in the right context, at the beginning of this year, in January 2022, the expected Fed Fund futures was 1%. And come October, November, the Fed Fund futures expectation is about 5.2%. So when this goes up from 1% to more than 5%, obviously the rupee cannot remain at the same levels. So our depreciation of 8-9% should be seen in that context, and we've done relatively better than most other countries. Energy is something which is not coming down in a hurry, much to the discomfort of many investors, strategists. And now when we see Warren Buffett's second biggest holding in his portfolio is energy, I think we may kind of reconcile to the fact that energy should consolidate at a higher level and with much higher level of cash flows, free cash flows for the investor. The other thing that has been happening of late is that while the buying by households of gold has come down, what we are seeing is that on an incremental basis, it is the central banks who are buying a lot of gold. Coming to the bond market, there has been some hardening of yields in India and in the US. In the US, it's because of the proceedings of FOMC meeting and the employment numbers. In India, the yields have hardened a little bit because of selling by foreign portfolio investors who had run in anticipation of inclusion of index in the JP Morgan global index, but that not having happened, so they have turned sellers. India's fiscal situation is okay. Government of India will not need to borrow any additional amount, and if there is a shortfall, then the small savings will come into play. The disinvestment and the flows from RBI will be lower this year, and that might take an impact toll on infra spending, but the states will come in and the states would be spending a lot more on infra. So on balance, infra spending should not get hurt. Banks have been reluctant to increase fixed deposit rates. Instead, they have relied on issuing commercial deposits, and this that has been gone up this year by 22% compared to the whole of last year. And banks have issued 3.5 lakh crores of CDs, and that's because I think they probably do not want to increase the fixed deposit rates significantly. However, the credit growth has been high, in addition to working capital growth and growth in personal banking. What we are seeing is that even the corporate capex spending also we are witnessing some traction there. So it remains to be seen how long banks will resist raising rates. The question in everybody's mind is that, okay, today we have high inflation, global inflation is about 9%, for the full year it's about more than 7%, and many expect the inflation to come down to 2-3% in a year. Does it have historical precedence? The answer is no. So whenever the world has had very high inflation, it does not come out quickly as is being anticipated currently. So it might take longer. But the point is, the bonds may move in a different trajectory, because today in many countries, including that of the US, the real returns is at the highest level in many years. So when US 30-year gives you a real return of 1.6%, I think that should attract some real money. So while the inflation might remain sticky, and the Fed Fund futures may even go up a little more, but from here on it makes sense to be investing in bonds, and on balance bonds definitely look better than equities. So there will be consequences for high interest rates, and we are seeing slowdown in the property sector, so that's for sure. And in India, the transmission has improved because of low liquidity overall in the system. Okay. Now sometimes you make changes to the interest rates and it does not get impacted, it doesn't impact the market interest rate because of high liquidity. But today, given the low liquidity scenario, any change in the interest rate is having an immediate impact. When we are plotting the distribution of and the bond performance over the years, what we find for the developed markets, this has been a left tail kind of distribution. Never in the history of bonds have there been such negative returns. So that in itself is suggesting that bonds are likely to rebound, and who knows, can give equity-like returns. Lastly, on asset allocation, what we are seeing, there's a research done, is that only 12-14% of small cap stocks eventually become mid cap and large cap. So it's hard. If you pick up 100 small cap stocks, only 14 of them is likely to be very profitable in the medium to long run. So again, something which emphasizes that may as well stick to passive rather than to be looking for active stocks in the small caps space. Thank you for listening, and see you again next week.